This inflationary picture looks like one that we're going to be continuing to deal with, although the Fed, Greg, does sound like it's going to be pretty aggressive. How should an investor walk away from that message?
Well, I would expect two things. The Fed's going to follow through on continuing to increase short-term interest rates. With that, we will see a slowdown in the economy. We're in that camp that we're going to see a slowing, but we'll also see the curve invert. So we're actually extending durations on our bond portfolios as we move out the yield curve to lock in yields that we haven't seen in 5 years.
Victoria, you say that right now, the best way to be an investor is to be boring. You want to explain what that means?
Yeah, I mean, it's look at blue chips, look at cash flows, look at dividends. Don't be chasing risk right now. Kind of shore up the portfolio. And we really want sustainability of cash flows and a quality stock right now. The high likelihood of a slowdown is there. And there's only so much the Fed can do about inflation. Some of these things are well outside their realm. Like if you look at both the earnings you were mentioning with Campbell and Hormel, it's because food prices and crop prices keep going up because we've had a terrible year for farmers. We've had horrible weather across the globe. It's not just in the U.S. and the Midwest. And we're anxiously waiting to see what some of these fall yields look like, but you have a lot of crop prices that are still rising. That means our input prices for food are still going up. And while oil's definitely moderated a little bit, it's still high in the 80s to 90s, and that still puts pressure on transportation costs. So there's a lot outside of the Fed's wheelhouse. So I think investors, it's too early to pile in. We're not buyers at the dip. Everybody knows September is the worst month. That's where all the bad stuff happens. Historically and technically, September is down like 1.25 on average. So just right now, it's patience. I think patience and quality are key.
I thought October was the month we really had to be more worried about. That's where you see a lot of the big drops that that catch people by surprise, Victoria.
September and October, the fall is very weak. September, historically, just on the heels of a bad August, is not a very good September. If you look through the different charting patterns, the fact we have a head and shoulders kind of that built and we really did bounce off that 200-day moving average, I'm just not very bullish. Obviously, October, you've had a lot of big dips, but you've also had a lot of September events. You've got the Fed, and you have all of these other macro events that are going to occur. Everybody comes back to work. Summer vacation's over. We're all going to start paying attention again, and it's just something that I think there's a lot of headwinds that are going to be hard for this market to climb a wall of worry.